Home prices fell in more than 3/4 of U.S. cities in the first quarter of the year. That's according to a report today by the National Association of Realtors. Our next guest says the housing market is facing a, quote, mortal enemy, a shadow inventory in the millions that will keep prices low for the foreseeable future. Back in 2008, Gary Shilling predicted the financial crisis and worldwide recession. A former Merrill Lynch chief economist, he's the president of Gary Shilling and Company, and he joins Matt and me in studio. Gary, good to have you back.
Glad to be back with you, Carol.
So housing a mortal enemy, what exactly do you mean?
Well, the inventories are the mortal enemy of prices. In other words, the way you get rid of excess inventories is cut prices, and that's what's happening. And particularly as foreclosures resume, a lot of these lenders and servicers, they just want to get rid of the foreclosed houses, so they dump them on the market. Prices are low, and that pushes down prices of competing housing units. So it's a spiral, and I think we've got another 20% decline in house prices with all the excess inventories.
How much time is that? I mean, what are we looking at as far as time to get these houses to market and off?
Well, our estimate is it'll take 4 or 5 years, given the current supply-demand conditions. We're producing a lot fewer houses now, a little over 500,000 starts, which is really the good news. The fewer you produce, the quicker you get rid of it. But the new household formation is only running about 800,000, and you've got some houses that replace those that are basically dilapidated and otherwise leave the market. But we think that it'll take to absorb the 2 to 2.5 million housing units over and above the normal inventory levels, the working inventory levels. It'll take 4 or 5 years.
So what does that mean for jobs and for the economy? Because obviously in the past recoveries, this has been a driver. Home building has gotten us out of it. Construction has gotten us out of it. And if we don't have it now, do we choke out here?
Yeah, well, we did some calculations. It's in our newsletter for May on this, and it looks like housing, residential construction is going nowhere for the next 4 or 5 years probably, but it's already low. It's only about 2% of GDP. It came down from about over 6% at the peak. But right now it's the financial problem, and that's where the trouble is. And if you get a 20% decline, we estimate that the people underwater, where their mortgages are worth more than their house, will go from now 23% to 40%. At that point, strategic defaulting, in other words, defaulting even though you can afford the mortgage, but you don't want to throw good money after bad for a house that's worth less than a mortgage, strategic defaulting becomes a cocktail party conversation piece. And it's very tough on consumer spending.
But how much of a drag is that then on the overall economy? We talk about how important housing is and the spending and so on and so forth. So, you know, net, what kind of a drag is that on the economy?
It is a drag, Carol, for 2 reasons. One is that virtually wipes out the remaining equity that people have in their houses. It's now 19% on average for anybody with a mortgage. It would go well below 10%. And I think that would severely impact consumer spending, which is 70% of GDP. And secondly, for any lenders and people who own the derivatives based on mortgages, they would be in trouble. A lot of banks have reported profits recently because, in effect, they took back the reserves that they built up earlier to account for bad mortgages. Well, they would have to reinstitute those.
Are you saying then what, another
recession?
Financial crisis, another mini financial crisis, another recession?
I think probably another recession coming out of this. I mean, the second trip through the meat grinder isn't quite as bad as the first one, because the first one was a shock to many people.
Still a meat grinder, though.
but I think it would be very tough. And of course, a lot of people thought a year ago that the housing crisis was over, and we had the tax credits for new homeowners, which gave a brief uptick. But when that was over, things just went back down. And again, you got excess inventories. You have also a situation where lending standards have tightened, where people realize for the first time since the 30s that they can and do lose money in a house. A house is not a winning asset anymore. People worry about unemployment. You've got a lot of unfortunate negatives for this whole area.
All right, Gary, thanks so much for joining.